I'd like today to highlight a few key differences between mainstream financial markets and the crypto markets as they exist. We'll see that while blockchain hopes to improve the workings of the financial markets as we know them, there's still a lot to be done actually in the other direction. We need to improve the workings of the crypto markets themselves. I'd like to use as a framework, the life cycle of a financial transaction as broken down between pre-trade, execution, and post-trade. Starting with pre-trade, it's actually they're doing quite well in terms of pre-trade. You have two segments that are relevant here. One is know your customer or KYC checks, and second, pre-trade credit checks. In terms of KYC, the Bitcoin and crypto exchange is actually doing quite well. The reason for that is very simple. It is extremely difficult as a Bitcoin company to open a bank account. So if you don't do KYC the right way, then you just get shut down. So I find actually that the quality of KYC for some exchanges actually exceeds the quality of the KYC that you can get with some larger financial institutions. Now, with credit, it's a little bit tricky. It's a bit of a moot point actually in the market because historically the crypto markets have worked on a fully funded basis where the exchange is also the custodian of the funds. So, if you want to buy a couple of Bitcoins, what you need to do normally is first you send a couple $1,000s to the exchange. Well, it's more than a couple thousand now. And then when the funds arrive, only then are you able to buy some crypto. Well, there's a variety of reasons for that, but we shouldn't forget that the Bitcoin enthusiasts really, really do not like credit. And certainly Bitcoin was in part a response to the 2008 credit crisis. Now, for better or for worse, credit is an important part of functioning in liquid financial markets. So what you see is that the lack of credit in the crypto market has a negative impact on their efficiencies. I can use a very simple market structure example. A lot of people play arbitrageurs between the major crypto exchanges, especially when it comes to the crypto pairs, because it's very easy to move funds around. Now, if for any reason there's a problem with the blockchain, then you very quickly run into inefficiencies. It could be the case that there's congestion on the blockchain, or one of the exchanges had their validating nodes go down for any reason, and very quickly the arbitrage breaks down, and you see prices get out of whack, sometimes by several %. So you really see the negative impact of the lack of credit in the market. Now, by necessity, credit did creep back into the Bitcoin and crypto markets in general. What you see now is that the major exchanges, the most liquid ones, they do offer leverage in one way or another. Now let's move on to execution proper. There's a similarity here between the mainstream and crypto markets, and it is that the markets are fragmented. If you want to trade FX, there's more than a dozen venues where you can do so. Similarly, in the US, the equities market is also very fragmented. But there's a very big difference between crypto and financial markets, and it is in the fact that the mainstream markets are very standardized. They're standardized in the processes, in the connectivity, in the protocols. So if you want to trade FX with JP Morgan or Goldman Sachs, it's not at all a technological question. It is purely a commercial decision. In crypto, not so much. The problem is that crypto is a very retail-driven market, and the actual institutions that are in the market today, that's often because they have a retail user base on the back of them. That means that because it's really driven by retail, and retail doesn't really care too much about the best technology, what you have is there's been underinvestment because the exchanges themselves haven't been able to justify the investment that would make it palatable to larger players. And so the larger players don't come, and so on and so forth. And actually, the exchanges that have done the homework of trying to improve, it's been very underwhelming in the response from the mainstream. So what you have now is a sort of patchwork of bespoke APIs and custom connectivity. That's actually a competitive advantage for a firm like ours, because we maintain a full team of coders dedicated to connecting and improving the connections to the exchanges. So in terms of execution, prepare to be disappointed and lower your expectations. Let's move on now to post-trade, which in my view is the most interesting bit here. Ironically, blockchain purports to fix post-trade in financial markets. Yet, crypto itself fails miserably at it. Three main issues. 1, no funding market. 2, no clearing. And 3, no custodians. Funding. Every major cash market relies on deep on a deep and liquid funding market. In foreign exchange, you have the FX forward market and the financing of spot transactions through top-neck swaps. In securities markets, you have repo, securities lending, borrows, you have margin loans, and so on and so forth. None of that exists in the crypto markets. Now, you might say, well, why do we need to separate trading and settlement anyway? Well, the reason is simple. The speed of trading will always be greater than the speed of settlement. People like speed. It is a fact of life, and we have to accept it. Now, one of the promises of blockchain is to improve settlements. Okay, I actually suspect that some people want to dream up a world where trading and settlement are one and the same and happen at the same time. Well, could settlements become faster? Yes. Could they become instant? Absolutely not. And nor should they be. There are two important trade-offs here that we need to keep in mind. One that is particularly relevant to crypto is the trade-off between the speed or frequency of settlements and the resilience of the payments infrastructure. It's very apparent in the Bitcoin block size, the very painful Bitcoin block size debates, where we see that the more transactions you want to push through the network, the more brittle it can become. There's also a second trade-off, which in my view is the more important of the two, and that's the trade-off between net settlement and gross settlement and its impact on the efficiency of markets. If I buy $1 million of treasuries in the morning and I sell my treasuries in the afternoon, under gross settlement, I need to maintain at all times that $1 million on my balance sheet. The problem is that it imposes a lot of pressure on the balance sheets of market participants if you want to impose gross settlements. On the other hand, with net settlements, I don't need to have that much balance sheet. However, it implicitly relies on intraday credit extension. But we need to keep those two trade-offs in mind. Now, let us assume that we accept post-trade settlement as a fact of life. What do we need to do now? Well, we need clearing. We need clearing because two important risks arise when you have post-trade settlement. The first one and the biggest one is principal risk. Principal risk is very simply when you deliver on your side of the transaction and your counterparty doesn't. That risk materialized in a very dramatic fashion in the 1974 bankruptcy of Erste Bank in Germany. The bank had received Deutsche Marks on the back of FX transaction in the morning and failed to pay the dollar counter value because it had gone bankrupt in the interim. That very incident led to the creation of the Basel Committee on Banking Supervision and was the brainchild of CLS. CLS and other entities like Euroclear, DTCC, that are really utilities that take care, that enforce payment versus payment in FX or delivery versus payment in other markets. Once you've got payment versus payment, you completely take care of principal risk through atomic settlements. You are left with, it has to be said, a second order risk, which is pre-settlement risk, which is the risk that everything that happens in between. So that can crystallize if you have a massive transaction followed by a significant market move, and one of the parties simply reneges on the transaction itself. That, in mainstream financial markets, is taken care of through a variety of collateral and margin agreements. The problem is, in crypto, again, none of that exists. And in a way, we're back to square one, where if you want to trade crypto, you have, to a large degree, to accept that you're going to have to take risk to sometimes the full notional that you're actually trading. So that really requires a lot of improvement. But again, let us assume that you managed to execute a trade, it's cleared, and now you move on to settlement. How does that work? You have to receive a couple Bitcoins. Well, we all know that anyone can run their own wallet. It's actually very simple. That's one of that's the beauty of Bitcoin. The problem is that a lot of institutions need to rely on third-party custodians, third-party valuations. So who's going to do that? There's a lot of startups in the space that are very good at security and do crypto wallets, but very few of them have been bold enough to go down the route of becoming regulated custodians. What about the incumbents? Well, it's not really their area of expertise. If I can do an analogy with Amazon, Amazon is in the business of safeguarding and moving around computer parts and stuff like that. But no one has ever suggested that Amazon gets into the business of safeguarding securities. It makes perfect sense. Both businesses are about storage, but it is storage of a very different kind. So it's going to take some time before the comfort level, the comfort zone of the incumbent custodians expands to encompass crypto. Now, solutions are being looked at. One thing is, okay, could we potentially at least have fiat custody of exchange? Well, it is a possibility, and people are looking at that. I think it's very interesting. But again, you have more problems here. I think from a perspective of fairness, I'm going to use an example. Last year, a large exchange went very close to bankruptcy because of a major hack. And in assessing what assets were left in the business to satisfy the creditors, it turned out that some customers had their fiat stuck in a payments processor, and the fiat was in effect inaccessible to the exchange, and those guys basically were bankruptcy remote. In my view, either everyone is bankruptcy remote or no one is. Because if it's only part of your customer base, then that's going to reduce recovery for everyone else. And that poses, in my view, also a question of suitability. Imagine a world where the exchanges for larger participants offer a custody solution of exchange. It's going to be only the large participants are able to take advantage of it because they have the operational capabilities. And retail is not going to be able to take advantage of it, at least at the beginning. So you might end up in a situation where half your institutional user base is bankruptcy remote and retail is not. And so, in effect, they take double the credit risk. We have to think about whether it's even appropriate to expose retail to such risks. Now, what we see basically is that if you want to transfer your bitcoins or your crypto, you don't need to rely on any third party, on any trusted intermediaries. That's really the beauty of it. But if you want to trade crypto, you do need to rely on trusted intermediaries. I find that very ironic. And in fact, not only do you need to rely on trusted intermediaries, you need to rely on those intermediaries to a much greater extent than you would in mainstream financial markets. So I'd like to conclude here by quoting Matt Levine, a journalist at Bloomberg that I find very, very witty. He says that cryptocurrency is about relearning all of the past mistakes of modern finance, but in a sped-up way. I have to echo his sentiment. I think that certainly there's a lot of good that's going to come out of the whole blockchain effort, and it's good anyway to get everyone around the table to talk about the very boring problems that we have with settlements. But uncomfortable as it may sound to the blockchain crowd, it's not just about blockchain improving the mainstream. It's also about time today that practitioners of finance bring their expertise and their best practices to this nascent, immature, but very exciting crypto market rather than only the other way around. Thank you very much.